Hello and welcome to Supercharge Your Finances, an education series brought to you by Prosperity Wealth Planning, designed to help you build your financial knowledge and financial confidence moving into the future to help you achieve your financial goals. Today we're going to be talking about the basics of investing, so let's jump into it. For today's agenda, we're going to be talking about why you should invest, also some common types of investments, some risk versus reward, how that relationship works when investing, diversification, how to achieve it and why it's important, time horizon and risk tolerance and how those relate to investing, how you can start investing, and once you are invested, some common mistakes to avoid. So first off, why you should invest. The one of the reasons is to pursue wealth. So investing can help your money grow over time through compound returns. So the longer that you are invested, the more time your money has to have the chance to grow through compound returns. The second is to beat or potentially beat inflation. So typically your savings will lose value over time. The reason for that is that as things around you become more expensive, savings naturally will lose purchasing power over time through inflation and things becoming more expensive. So if you were to invest, your money has the chance to grow and potentially beat inflation. And the last is to reach your goals. So as you invest, as you start saving, as you invest, you have the highest potential to achieve your goals, from education to purchasing a car to purchasing a home. Investing has the most potential value there for helping you achieve those goals. For common types of investments, number one is going to be stocks, one that we're all familiar with. What is a stock? A stock represents ownership in a company. That's essentially them extending to you partial ownership in exchange for your dollar. That dollar they then take and they reinvest in their company and with the hopes of growing. And as they grow, because you're partial owner, you also participate in that growth. You also have the potential to receive potential dividends from that company, which is a repayment of some of the earnings that the company makes. A bond is going to be um, typically less volatile than stock. A bond is essentially an IOU from a company. So you essentially loan a company or the government your money, and they repay you in the form of interest. And so because of that, because it involves more of a stable income, then with those interest payments or coupon payments is considered to be less risky than a stock. Mutual funds and ETFs, those are essentially going to be a group of stocks or a group of bonds. So a group of stocks could be considered a fund. A mutual fund is one of those types. An ETF, also known as an exchange traded fund, is another type of fund. So we'll go over the differences between those, but essentially that's what those are pooled stocks or pooled bonds together. For types of stocks, we have large cap stocks, which are going to be the largest stocks out there with market capitalization, which essentially means the value of that stock on the exchange where it's selling, starting at 10 billion. So, a common example of this is going to be the S&P 500 or 500 of the largest stocks in the U.S. Mid cap is in the middle, so mid value companies, and small cap is the smaller companies. When it comes to non-U.S. stocks, there's two main types I want to review. The first is going to be international, so that will be any foreign or non-U.S. company. And emerging is also non-U.S., but this is for companies that are based in developing economies. For types of bonds, we have first off Treasury bonds. These are going to be issued by the US government, considered to be very low risk because they're backed by the faith and credit of the US government. You can get these in all different types of forms of maturity or time limit on these bonds. So you have T bills, short term, T notes, midterm, and T bonds, which are going to be long terms, anywhere from say 3 months to 30 years. You can get that IOU from the government. Municipal bonds are also government issued, but these are actually state, city, and local governments. These are beneficial because they're considered to be tax-free at the federal and most often at the state level as well. The reason that states, cities, and local governments will issue these is to help fund public projects like a school or a highway or a bridge or any project that they need to raise some money for. Um, the last is going to be corporate bonds. So these, instead of being issued by a government, are going to be issued by companies to help them raise capital for themselves. Um, these are going to be considered higher risk than government bonds because they're not backed by the government, they're backed by the company. But because there's a little bit of that higher risk, it usually means that there's going to be a higher yield. So, kind of higher risk, higher reward with corporate versus treasury bonds. So, pay attention to that. And because there's some risk involved, these are going to be rated by credit agencies. And so if you look at a bond, you can see if it's a higher rated bond, less risky is going to be something, say, like a AAA rating. And if it's a lower rated bond, it can get all the way down to a junk bond. When it comes to mutual funds versus ETFs, mutual funds are more of the historical type of fund. They've been around longer. These are going to be less flexible. For instance, they can only be bought and sold at the end of the day. These can be actively or passively managed. Active means that there's a fund manager going in there, making specific decisions, trying to gain investment returns above market performance. They can be passively managed as well, but typically tend to be more on the active end. These typically will have higher fees because of that, because they're more on the active side of things. They are naturally less tax efficient just with the vehicle of a mutual fund. So there could be some capital gain exposure there. But they are easier or can be easier for automatic investing. These mutual funds are typically going to be the option, say, if you invest in your company's 401k, they're going to offer you some mutual funds, and they're better for automatic investing for that reason. You contribute to your 401k, that money goes into the investments automatically and starts getting invested for you. Exchange traded funds are a bit different, so these are going to be more flexible. So, for instance, they can be traded like a stock during the day. The price fluctuates during the day, giving more flexibility of when to buy and sell these investments. They typically tend to be lower fees. The reason for that is that these tend to be more of a passive investment. So instead of having an active money manager in there making decisions on what types of stocks are going to be in these funds, you can say, well, I just want this ETF to track a certain benchmark, like the S&P 500, for example. And because there's not as many decisions being made, they can charge a lower fee. And so these tend to be lower fee, also more tax efficient. So naturally, these aren't going to have as much of the capital gains being pushed to you. So less tax exposure there for ETFs, and great for flexibility. When it comes to risk versus reward, these two things are linked when it comes to investing. So if you want a higher reward, you're also going to be exposed to some higher risk. So higher risk, higher reward are typically reserved for longer term investments. And that's going to be, for example, like a stock. Lower risk, lower reward potential, for example, like a bond, is going to be reserved for something like a shorter term goal. When it comes to diversification, this is a neat chart that I like to show. This is an asset class return chart, also known as an asset class return quilt. The reason that gets that name is for all the fun colors in there. And essentially what this chart is showing here is market returns dated back to 2010. The different boxes with the different colors are different asset classes. And so the ones at the top are going to be the highest performing asset class for that year. And so as you look back, you can see that there's typically going to be a different asset class that's going to be overperforming in given years. And it's really difficult, if not impossible, to predict which one is going to be first, which one's going to be second, and what order those returns are going to be. And so the way that you can diversify is by holding different portions of different asset classes, so diversifying across different asset classes. And actually in the middle of this chart are a bunch of gray boxes, and that is representing a mixture of different asset classes. You can see that the return of those is more mediated over time. And so it's not going to be the highest performer, lowest performer, but it's going to be a diversified return over time and give you more of a stable return, as opposed to trying to pick and choose the winners and losers. When it comes to time horizon, we went over this a bit when we talked about risk versus reward, but there's typically 3 time horizons that we like to focus on. It's short term, medium term, long term. So when you are investing, be sure to consider what your time horizon is for that goal. If the goal is to buy a car in the next year, that's going to be a shorter term goal. If your goal is to purchase a home in the next 5 to 10 years, that's going to be more medium term. And if your goal is to save for retirement in 30 years, that's going to be considered long term. So be sure to keep that in mind. And then also keep in mind your own risk tolerance. So as you're investing, how comfortable are you typically with ups and downs? The best investment is one that you can actually hold on to and stay invested and not have to get in and out of. So one that you're comfortable holding on to. So how to start investing? The first thing that you want to do is to choose your goal. What are you investing for? A big reason for that is you want to know what the time frame is on that goal when it comes to the timing of investments that we were just talking about, those time horizons. The second is going to be choose your account. So there are different account types for different goals. 401ks, for instance, are going to be great for retirement. A brokerage account would be great for, say, saving for a car. And then 529 plans are going to be great for saving for education. So do some research and know what the best account type is for the goal that you're trying to pursue. And the last is to choose your investments. So try and diversify, take into consideration your time horizon. If you have a lot of time to try and achieve this goal, if it's a shorter time frame, also take into consideration your own risk comfort level, your risk tolerance. And then based off of that, do some research, find the best fund or stock or bond that's related to that goal. Funds are going to be an easy way to diversify. So that's a good place that you can start looking at. And then once you are invested, what are some common mistakes to avoid? Number one is going to be trying to time the market. So we like to say it's more about time in the market than timing the market. So instead of trying to sell right before a drop, just make sure that you are able to get into an investment strategy that you can hold on to and stay in your investments for a good amount of time. The second is going to be emotional decision making. So there's a lot of emotion side to finances, especially when you're invested. Things go up, things go down. So as things go down, just try not to make emotional decision making in the moment. Try and take a step back and be as objective as possible making those decisions. And lastly is going to be chasing performance. So oftentimes people like to see the high performers and get into those. Lots of times after things have already had that high performance and that jump up in value, a lot of that value is already being reflected in the price of that stock. So as you get in, you're a bit behind the curve. People often still try and do that and chase performance. It's best to, instead of chasing performance, invest according to your goals, your time horizon, your risk tolerance, and that is going to be the best way to help you achieve your goals. Well, that's it for today. Thank you so much for your time. If there are any more questions or you'd like more information, please feel free to contact us at info@prosperitywealthplanning.com. Email us there, or you can always visit us at our website at prosperitywealthplanning.com. Thank you.